Anand Tandon as well. He's joining us on the show to talk to us about the fundamental perspective of the market. Anand, hi, thanks so much for making time and speaking with us. Want to begin by talking about a laggard in the trading session today, and that's pharma space. Off late, it's been doing okay, but it's a very divergent move that we see. Whenever the markets are under pressure, pharma outperforms, but when market is doing well, pharma underperforms. How should one tackle this situation, and what should one do with the pharma sector?
Well, that kind of makes sense, right? Because pharma is not going to be giving you dramatic changes in terms of sales. By and large, it has a steady near double-digit growth in the domestic market, and then there is, of course, the companies which are also exporting. So there is a lot more predictability in terms of the kind of numbers that you are likely to get from pharma, and therefore, whenever there is a bullish market where, let's say, the commodity prices move much more volatile in a much more volatile manner, they will obviously show higher earnings or upgrade or downgrade as the case may be, and therefore they are likely to perform, at least in the near term, will perform a lot more than something which is a little more steady state than pharma. The situation in pharma for now is that the domestic market is doing a little worse because of the fact that monsoons have not been very high. That's usually a time when the infections go up the most. So the sales in India are a little more muted. That is counterbalanced for those which export by better realizations in the US market by and large, and a whole lot of one-off cases depending on the companies that you are looking at. So you have to be a little selective. The domestic marketplace, which was the flavor for most fund managers in the last 6 months, as I said, will take a little while before they were to show the kind of growth that one was anticipating. But the international market is showing a bit better strength, and therefore that's a place where the numbers are likely to be better for the current quarter at least.
Anand, many believe that the market is only going to scale up higher, and the knee-jerk reaction from the turmoil in Israel and Hamas is, behind us. What do you believe is going to lead us all the way if we were to test those fresh highs in the near term?
First of all, you have to keep in mind that the markets are no use at trying to predict events which are non-linear. A war is not something that the market can anticipate or, for that matter, even play for. Therefore, the best thing that the market does is it continues as business as usual unless there is some immediate trigger that it can look at, and ignores the rest of it, and you deal with it as it comes. So from that perspective, the market is doing what which is what it should be doing, which is continuing with the trend that it was seeing in the near term. It doesn't mean that the risks have gone away. There is a serious risk of escalation which is still there, but how do you play for it? So therefore, you continue to ignore it and hope that eventually things will settle down, as they mostly do. Which are the sectors that can do well? Well, if you are looking for the current earnings season, for example, that we are just getting into, you are likely to see very strong earnings coming in from, for example, the oil and gas sector, largely because of the base effect. Last year, this quarter was not good. So therefore, this quarter, they will show much greater numbers. But many of the other sectors are also doing reasonably well. Auto is likely to report good numbers as well. And because of the fact that auto is a sector where the operating margins tend to be much better when the volumes increase, there is a potential surprise element that may come through in terms of the earnings, because wherever the volumes are better than what the analysts are expecting, there is a possibility that you will get an expansion in margins, which is much more than what the forecasts currently reveal. For the others, of course, the domestic consumer space is muted on the rural side, doing quite well on the urban and especially on the luxury segment. And therefore, you are likely to see, that's where the positioning will be for any portfolio. So by and large, domestic focused, especially on the higher end of the consumption curve. The current positions are obviously very overweight on terms of defense and railways and government infrastructure. My belief is that it is time to take some of the money off, because they are factoring in all the positives and not factoring in any of the possibilities of a slowdown, or even a marginal slowdown has not been factored in. So I would stay a little away from that. Again, the private sector banking has not done well simply because of the fact that the public sector has done well, but at the same time, the assumption is that the margins will have kind of peaked out. I think that's a fair assumption to make. The margins would have peaked out, but the numbers will continue to grow, and therefore, I think banking, etc., especially in the private sector, would be something that one could be looking at again going forward.
Vertical that has been doing quite well is of course urban consumption, and within that the jewelry stock have been doing quite well. Kalyan Jewellers has almost doubled on a YTD basis. Titan has been inching higher. The latest IPO which was there, Senco Gold, also saw massive subscription, and since those levels as well, it's managed to gain quite a bit. What's your take as far as this space is concerned, and what would be your top bet within the segment?
Obviously, as you mentioned, Kalyan has actually done exceedingly well. Perhaps in jewelry, they have actually done better than even Titan in terms of volume growth. There are other smaller players also which are a little more regional, which are doing quite well. Clearly, the numbers are coming through are fairly strong, and with no signs of the underlying metal weakening in terms of prices, at least in the near term, it is likely that at least for the near term, the performance will be sustained. This season, for sure, they are likely to report decent numbers. Next season, next quarter also, the numbers will be good because of the fact that we are into the festive season right now, and therefore this is the part of the year where the maximum sales will likely materialize. So I don't see a problem in these companies, barring aside the valuations. To the extent that you are comfortable with the valuations, at least you are reasonably secure that the top line and the bottom line can continue to grow for especially those who've already delivered the kind of growth that one was looking for.
And actually, this is something my colleague Winnie also was pointing out when she was discussing with me in terms of the valuations. What was the differential with Titan earlier? What is it standing at? And what is actually, Kalyan managing to do differently? Because they have been looking at deleveraging their balance sheet on one hand. They're also looking at franchisee model, which means that their investment is lower, and that helps to improve their profitability as well in terms of ROE as well as ROCE. They are looking at expanding the capacity when it comes to Northern India as well, apart from the fact that they had a very strong hold in South already. So all of these factors seem to be working well as far as Kalyan Jewellers is concerned. We'll try and get Vinny very shortly about that. But in the meantime, Anand, your take as far as the Adani group of stocks is concerned as well. Adani Ports, after that, cut off almost 5% yesterday, seeing a bit of a relief rally. And even JSW Infrastructure, for that matter, even though it didn't have any exposure in that area, that stock continues to do quite well.
Well, yes. So for Adani, obviously, they have clarified that the amount the revenues that come from Haifa is very small yet, early single digit kind of numbers. Therefore, it's not going to make a major difference in terms of the overall performance of the company, at least in the near term. One, of course, assumes that what we are seeing in terms of action will not spread, and therefore it will not become a problem. I personally think that between the two, Adani probably is cheaper than JSW, for example, in terms of the relative growth and value and the valuation that you're paying for it. But more importantly, I think the range of ports that they control, the 11 odd ports that they have got, and the spread across the geography makes them very well positioned. There is a significant possibility of increased business because they are operating at less than half of what their probable capacity is. And more than just the port, there is also the hinterland, which they have very large chunks of land, which they are trying to develop in terms of various for various industries to come in and move there. So overall, I think, given the fact that their net debt to equity is very comfortable, the operating margins have been showing signs of improvement. The ROE is already around 16-17%. I think there is a case to be made for investing in this kind of business model.